Okay, Chapter 9, Part 2. Again, you have to, as management, you have to estimate what you think your bad debt expense will be for some period, typically like on a yearly basis or quarterly or monthly. Again, there's two methods, percent of sales methods and then the accounts receivable method, which is two types. One is a percent of accounts receivable and then aging of accounts receivable. So let's go into what this means here. So percent of sales. So you take what they're saying here is you're going to estimate, let's say like 2% of all your sales are going to be bad debt. Well, you just simply estimate it by 2% of your sales volume. It's pretty easy to do at that point. Here again, they're estimating it at 0.6% and so forth. And so how do you get that 0.6% or 2% of sales? Usually experience in the business or industry norms. Now management can adjust that number and sometimes they will do so based on maybe their outlook on the economic front. If they think we're headed toward a recession, they might increase that. If they think things are going to be good or stay good, they might reduce that estimate. So management's not locked into that estimate. They can change it based on what they feel is going to be more accurate. The other one, which is comparable to the percent of sales, is just simply a percent of accounts receivable. An example would be maybe 50% of your sales in cash. So why would you estimate it based on your cash sales? You've collected that. So sometimes they'll do it as a percent of their total accounts receivable. So it's very similar to the percent of sales. Again, here they're doing 5% of their maybe their accounts receivable. So again, how do they get the 5%? Management's best estimate. The aging of receivable methods. We need to spend a little bit of time here. So what happened here is that now we're going to break down and analyze our accounts receivable. And we're going to classify it by how long it is past due. And then each age group, we're going to give it a certain percentage estimate. And then we're going to total those up to get a more specific way. So what do I mean by its aging? And so we'll look at accounts on customers, and here's your aging like it's not due yet. 1 to 30 days, 31 to 60 days, 61 to 90, and over 90 days. Well, here what they're saying is a lot of times we make sales due, like 210 net 30. Remember that concept of 2% discount if you pay in 10 days, but the net amount is due in 30. Well, that net amount would be this net 30. From 31 or to 60 days, you're going to start moving it down, because if they didn't pay you in 30 days, as your N30 suggested, now they're becoming overdue. And as it gets to become further and further overdue, you're going to increase your percentage of what you think of now is going to be bad debt. Or if it was only, you might be only estimating 2%, which is for the total sales here, or accounts receivable that's due. But by the time they're 90 or 120 days past due, now you're estimating maybe 1/4 or maybe even 40% past due. And so now you're getting an aging on that. And a lot of businesses use this method because it tends to be more accurate. So you should be aware of that. And bankers will look at this and ask for this kind of information, which is beyond the GAAP acceptable principles. Typically you're not looking at just the balance sheet, but now we're getting into looking at your accounts receivable. So banks will tend to look at this. So this aging of accounts receivable is used quite commonly here, so become familiar with it. And again, they're going to create this allowance for doubtful accounts, and they're going to move it up. We estimate maybe the proper amount was as an unadjusted, but we're going to now estimate it at 2270 because they're maybe 90 or 120 days. So now you're going to increase that amount allowance for bad debt, and you're going to put it back into the bad debt expense. But now your allowance is increased to 2270 because you had 200 there before. So you have the summary of methods. You have the income statement, which is the percent of sales, or balance sheet focus, which is a percent of receivables, or the aging of receivables. Okay, let's get into some other account types of receivables. Notes receivable. And a note receivable is a promissory note it's a written agreement. And typically, here's an example of one. You'll have the amount, the date of the note, 90 days, maybe the due date, who's the company, and then the principal amount is spelled out, not just numeric, but spelled out, and then maybe the interest rate that they're going to be charging on here. And then who's making this note, okay? So you're going to have a few things here. You have to start watching. Now you're going to have an interest receivable as well as interest revenue account if you're charging interest. So it's going to be a little bit more complex here. And people like getting things in writing because it has stronger legal precedence in the courts. And so when someone maybe is getting past due, you might convert them to a note. So they are, again, at least acknowledging again in writing that they do in fact owe you this money. It does stand stronger in the court system. So so you might convert an accounts receivable to a note receivable. And maybe you're giving them more time now, but you want to be paid for your time, hence the interest rate. Or maybe you sold some equipment. So there's different reasons why we have notes receivable. And then now you have to compute the maturity and the interest rate, because if you had a 90-day note at 12%, well, what are you going to do on your monthly statement? You've got to calculate how many days. We're in July, how many days are remaining in August and so forth, because you're going to have to calculate that interest receivable for each of those periods. And so it can be rather cumbersome from an accounting standpoint because you're accruing this interest. And so the basic formula is P times R, which is interest rate, times equals interest. And the confusing thing here is that we know what the principal amount, but we're going to state the annual interest rate. So if it's 12% for a quarter, you put 12% down, but now you put it in the time period in a fraction, and it's the number of days over 360. And that 360 has a special name known as the banker's rule. And the banker's rule is simply bankers are greedy, and they figured out, let's don't do it on 365 calendar days, let's do it on 360. We'll get another 5 days interest. Yep, that's how bankers operate. So anyway, so you need to know this formula. And I just simply call it P times R times T. Principal rate times equals the amount of interest. And then you can just simply plug in your numbers and calculate it out. So to recognize it, you might have made a note receivable on a sale. Simple, just record $1,000, record $1,000. But here, you do want to put an explanation, right? The term and the rate in your explanation here. That will help you immensely. So notice how this explanation is going to be much more. And you might say from who? Who's note receivable? So you might even want to add more detail there. And so here, someone's going to actually pay you. And so they paid you $615. Of $600 was the principal, and $15 was the interest, and then you would just put your calculation there. So notice you're having a note receivable and interest revenue account. Okay, you got a couple more T accounts going into your chart of accounts here that you need to start keeping track of. Dishonoring a note, again, this might not be paid, and so this accounts receivable, interest receivable, $800. So here you're taking it out of accounts receivable, and now you're putting it into a note. This person hasn't paid you. interest receivable, interest revenue. You've got two different things here, so be careful. Interest receivable and revenue is two different things. This is the asset, right? This is an income statement. And then you have end of the period interest adjustment. So this can be an adjusting entry also, because you might have on December 31 some interest revenue, but you haven't been paid yet. You might not get paid till January 15th. And so you have to recognize that interest revenue, but also as an interest receivable on there. So it can get a little confusing, so be careful you understand these distinctions here. Disposable, again, you can collect on your accounts receivable, but you can sometimes also sell them. There are companies called factoring, which will go buy companies' receivables at a discount because they're in it to make money, but allows you to not the hassle of trying to collect it. They'll do it. So this is very common, and there's certain industries that really do practice this quite a bit. One would be the clothing industry does this extensively for whatever reason. So managing your receivables, first thing is you have to determine whom to extend credit to. And so this requires financial analysis of your customers. So you need to review their financial statements, determining a payment period. You need to monitor your accounts receivable. You need to estimate the liquidity of that. And then you want to also accelerate cash receipts. This is where, how do you accelerate it? By giving them some, for instance, like a 2% discount if they pay in 10 days. And a lot of people will utilize that discount. So there's different things that a CFO or chief financial officer or the head bookkeeper of a company will be involved with on that accounts receivable monitoring. Again, accelerating cash receipts, you can give a discount as an example, or maybe you'll simply sell it. That's one of the two ways that people typically do that. Okay, so Visa, MasterCard, here's your general journal. Just be careful. Cash, you got a service charge expense, and then your sales. Okay, and this is if the company's paying you right away. If they're going to pay you in 5 or 10 days, then you, instead of cash, you're going to have accounts receivable, Visa, accounts receivable, MasterCard. So you have to be careful of that. And one thing that is tracked for one ratio, which will conclude this chapter, I only have a minute left, is they'll track the amount of receivables as a result of the amount of sales. And then they'll have an accounts receivable turnover ratio. So this is used a lot by a variety of industries to track this one. That's the end of this chapter, and we will end here, and we will start with chapter 10 on a later date. Thank you.